All right, let's bring in Kevin Green, senior markets correspondent here on the network to help set up the action today. KG, it's always good to see you. Still there over there, holding it down in Chicago. All right, let's talk a little bit about the overall market first before we get into some of these earnings that we have to chew on, and then this deal news as well. So we've seen this kind of grind higher when it comes to the S&P 500. It looks like we're getting a little bit of pushback today, but what are you paying attention to when it comes to overall momentum and the broadening?
Yeah, I think we've kind of talked about this over the last couple of trading sessions. We've had some really decent gains over the last couple of weeks here, but we are probably seeing a little bit more of a consolidation, hitting that 5,900, 5,905 level, and we just haven't been able to push through yet. And maybe the economic data that we're going to get at the bottom of the hour is going to be enough to really try to push us over the top here. We have PPI coming out. We also have retail sales. And yesterday's market breadth really did kind of consolidate a little bit. We saw a little bit of participation to start the morning, but it really got concentrated into the Mag 7 names, communication services, the Metas, Googles of the world here really kind of held us up, while a lot of the other sectors saw a minor little pullback here in the market. But nothing too aggressive right now. We do have volatility sitting at around 19, so we're kind of back into that normalization type of range there. You do also have a situation where there's still some risk on tone in the market, especially if you're looking at high beta tech stocks or even the nuclear sector seeing some gains here. So consolidation's normal in this type of environment. Even a pullback, even coming back down to say 5,500, actually technically would be still bullish for the market right now. Come back, retest, and then push higher, I think is ultimately the goal for a lot of traders that are trying to trade this market on a 2-week, 3-week basis.
And we'll get back to overall levels that you're paying attention to on the S&P 500 today, besides to the downside. But let's take a look at one stock that we're paying attention to today. Walmart out with its latest quarterly numbers. Looks like it was mixed numbers, beat on the bottom line. Take us through, recap some of the data here.
Yeah, so for Walmart, beat on the bottom line. The adjusted earnings per share came in at 61 cents. Street was looking for around 58 cents. But the top line did slightly miss here, coming in at $165.6 billion. Street was looking for around 165.84 billion, so a couple $100 million or so. Not that bad of a beat on the top line here. When you're looking at comp sales ex fuel in the U.S., Walmart actually saw growth of around 4.5% on a year-over-year basis, and Sam's Club actually still seeing some really good positive numbers here when you're looking at same-store comp sales growing at around 6.7% on a year-over-year basis. Now, the U.S. e-commerce sales and e-commerce alone as a business unit did actually achieve profitability for the first time here when you're looking at it on a global scale. That's a good thing. They've rolled out a fair amount of new product offerings like Walmart Plus that has really driven a lot of that activity here. But a couple of things when you're looking at the guidance. They did provide fiscal year 2026 guidance. They're looking for sales growth of around 3 to 4%. That's their range. And they're looking at the adjusted earnings per share sitting between $2.50 to $2.60. But one thing to note, they did not provide the Q2 EPS and or Q2 operating income guidance because of the tariff impact. And their CFO did mention that consumers probably could see price increases towards the latter half of May because of the tariff policies that are in place. Regardless of if we brought them down, the 30% tariffs are still something that they have to pass on to the consumers. And they believe that the whole overall industry is going to do the same.
Yeah, look, I mean, I remember on their last earnings call, they talked about the expectations for the need for price increase, or following their last earnings calls, talking about that and the impact of tariffs and doing their own negotiations on that front when it came to vendors and whatnot. Interesting to see that it seems like so far the street is focused more on the positive. Obviously, that could, possibly change once they have their earnings call. I wonder if they'll be as cautious on this earnings call as they were on their previous one. What are you looking to hear from the earnings call, KG?
Well, the positive here is that they are going to pass those prices off to the consumer. We know that Walmart obviously has a major footprint on the global stage here, and usually when we see increases from retailers when it comes to prices, they do not go lower. So the fact that they are actually going to take the initiative in order to try to preserve margins because of tariffs, I think is why we are seeing maybe a little bit of a boost to the upside. And that's just kind of the nature of the beast. Yes, you might see a little bit of slowing for a quarter or two, but overall, if you look at the next year or so, those prices that they're going to increase probably will not come down or ratchet down. So when you're looking at the staples companies, shocks like this hurt for the first quarter or 2 quarters, but actually it benefits them over the long term for margins in general.
Yeah, interesting. And I also thought your point about e-commerce doing well for them, because there was that question. I know analysts were looking for some growth there compared to, for instance, Amazon. But let's pivot. Let's take a look at this Dick's Foot Locker deal. Dick's setting up to acquire Foot Locker. Foot Locker shares rallying off the back of this. It's clearly because of the premium that Dick's is paying for the shares. But recap what's happening here.
Yeah, we are seeing the shares obviously move a lot higher because of this news. Now, the estimated takeout value is around $2.3 billion. That would be around a $24 a share takeout price for Foot Locker. And this is more of 2 strategies that are actually kind of wrapped into one. There's a sense of the retail, especially when you're looking at athleisure type of retail products and footwear here. There's a consolidation in this market. Foot Locker has seen a lot of weakness because of the different directions that we've seen Nike take when it comes to direct to consumer. It seems like they're still trying to figure out that business here. So they're taking out a potential competitor, but it also gives them a little bit more leverage when you're looking at the major suppliers like a Nike. So they are able to have maybe a little bit more price discovery and maybe push their margins up a little bit here. It seems like they're going to run these companies as separate entities for now, which will be an interesting strategy. I mean, we've seen companies pull it off and it's successful, but the biggest risk that you have there, Diane, is operating efficiency losses. And so we'll see how Dick's is able to kind of pull this off, but they have been able to manage their business fairly well here, and it seems like they want to potentially close this deal by Thursday, by today actually. So this is going to be interesting to see how this is going through. The aggressive nature of the price offering too gives you kind of a sign that they really want to take this company out, and they do not want to have a back and forth negotiation. Paying a 90% premium compared to current prices, give or take, is very aggressive in an acquisition like this.
Yeah, it certainly seems to be the case, but it's interesting to already see an analyst view on this. TD Cowen not liking this. They're downgrading Dick's to a hold from a buy, and they call this a strategic mistake. It's interesting to see that, because you and I know Foot Locker has had a very difficult time over the past couple of years, so I can see what TD Cowen's point is here, but there has been consolidation just overall in this space. When you think about Skechers, but that was a PE deal there. Any final thoughts you want to leave us with on this deal to pay attention to?
Once again, it's going to be the supply management for Dick's Sporting Goods. That is going to be the key here. I understand the skepticism, and once again, we kind of talked about running 2 brands is very hard to do, where you can actually consolidate into one brand. You're not paying as many expenses for operating 2 companies here, but let's just say theoretically they are able to get better pricing power, let's say from a Nike, let's say 10%, 15% better prices. I mean, from a profitability standpoint, it might actually outweigh some of the risks that you have for acquiring this company in the manner that it's doing right now. It just depends on how much leverage, perceived leverage they're going to have when it comes to the suppliers over the next year.
Okay. All right. Potential. How much, as you mentioned, perceived leverage. Let's talk a little bit about Cisco. Shares higher right now. They reported after the bell yesterday. Catch people up on some of the numbers here.
Yep. So we see Cisco beating both on the top and bottom line here. When you're looking at the AI infrastructure orders, a lot of that is coming from web companies, over $600 million so far. And then for fiscal year, total year to date orders, you're looking at around $1.25 billion. That's actually a lot more than they have projected for the year alone. So they're outpacing themselves when it comes to the AI tech and infrastructure business. They do have their CFO actually retiring, and they have a new successor getting into place here. The networking revenue, a big driver of their sales, actually did beat the street's expectations, coming in at $7.07 billion. Street was looking for around $6.8 billion, but the security revenue did come in a little bit short. The guidance both exceeded the top line and bottom line estimates for the street, which is really, really good. And they also included in that guidance, which was a beat, the impacts of tariffs on their business, something that's a little bit more unique that we've seen in this earnings season from this company compared to others that have maybe deferred providing any type of guidance because of the uncertainty with tariffs. It looks like they are building their expectations already into their guide, and once again, better than the street's expectations. You're seeing a little bit of a pop. Cisco really does not move that much on earnings regardless. So, it was a 3% move, 2.5%, 3% move is actually a pretty decent move for the stock.
Okay, and we're seeing some analyst activity around this. Wells Fargo boosting its view on Cisco to overweight after its latest quarterly numbers. All right, KG, you know the people want to know your targets on the S&P 500. So where do we go? I know you indicated the levels you're paying attention to the downside, but let's do that again and to the upside.
Yeah, to the upside, obviously your first area of resistance is going to be around that 5,900, 5,905. I'm still looking for 5,940 to the upside if we get some really good economic data here in the next 15 minutes or so. To the downside, I'm looking at 58.15. So kind of a compressed range here, and hopefully it's kind of a boring market. You'd like to see more consolidation here and maybe a little bit of a rotation to provide some opportunities for investors here.
Well, you make a great point about the potential catalyst here because CPI was a catalyst on Tuesday, so PPI could potentially be a catalyst today, but we've got a few pieces of economic data to chew on today. All right, KG, thank you. That's our Kevin Green, Senior Markets Correspondent.